Alright, let's get right into it. The words crypto and taxes in the same sentence can sound a little intimidating. It's like mixing peanut butter with, well, something that definitely isn't jelly. But here's the thing, it's really not that scary once you break it down. Think of it like a video game. You play, you win some levels, you lose some, and at the end, you just have to report your final score. That's all crypto taxes are. It's a system for keeping track of your wins and losses in the crypto world. Today, we're going to walk through it step by step with a double shot of coffee and make sure you understand exactly what you need to do. No complicated jargon, no confusing charts, just simple, straightforward talk. So, what are crypto taxes really? In the simplest terms, it's just the tax you owe on the profits you make from your cryptocurrency activities. Most governments don't see crypto as money like dollars or euros. Instead, they classify it as property. This is a huge deal. It means your crypto is treated like other assets, stocks, bonds, real estate. This single classification is the root of all crypto tax rules. It's why you don't pay tax just for holding it, but you do when you sell it, trade it, or use it to buy something. This property label creates taxable events. A taxable event is any action that can trigger a tax liability. Buying and holding isn't a taxable event. You can buy Bitcoin today and hold it for 10 years tax-free. The taxable event happens the moment you dispose of that Bitcoin. This includes selling it for cash, US dollars, Norwegian krone, or other fiat. It includes trading for another cryptocurrency, swapping your Bitcoin for some Ethereum, and using crypto to buy a cup of coffee or a laptop. Each of these actions is seen as you selling your property. Let's use an easy example. Say you buy one coin for $500. This is your cost basis, the original price you paid. You decide to sell it. Profit equals selling price minus cost basis. 2,000 minus 500 equals 1,500 profit. That profit is called a capital gain. That's the number tax authorities care about. You're taxed on the 1,500, not the full 2,000. It also works the other way. What if you bought for 500 but it dropped to 300 when sold? That's a capital loss of 200. Capital losses can offset capital gains. Subtract the loss from the gain. You'd be taxed on the net 1,300. This is why tracking wins and losses is so important for every investor. Now let's zoom in on how two different countries, Norway and the USA, handle these rules. While the core idea of taxing crypto as property is similar, the specifics can vary. In the USA, the Internal Revenue Service, or IRS, was one of the first major tax agencies to issue guidance. They've been very clear. Crypto is property. This means every time you sell, trade, or spend your crypto, you are realizing a capital gain or loss. The tax rate you pay depends on how long you held the asset, short-term versus long-term. Short-term capital gains come from selling assets held for 1 year or less and are taxed at your ordinary income rate. Long-term gains, held more than 1 year, are often taxed at much lower rates, 0, 15, or 20%, depending on income. Over in Norway, Skatteetaten has a similar approach. Crypto is treated as a capital asset. Gains from the sale of crypto are considered capital income. When you sell or exchange crypto for a profit in Norway, that gain is typically taxed at a flat rate. As of recent guidance, the rate is 22%. It doesn't matter if you held the crypto for 2 months or 2 years. The rate is the same. For both countries, the principle is the same. Sale price minus cost basis equals gain or loss. For example, if a Norwegian resident buys Bitcoin for 100,000 NOK and later sells for 150,000 NOK, their capital gain is 50,000 NOK. They would owe 22% of that profit, 11,000 NOK. Similarly, an American buys Ethereum for $1,000 and sells it within a year for $1,500. That 500 short-term gain is added to income and taxed at their rate. Okay, so you understand what a taxable event is and how gains are calculated. Now, for the most important part, how do you actually report all of this? The first step, meticulous record keeping. Keep a detailed log of every crypto transaction. For every transaction record, date acquired, price paid, cost basis, date sold or traded, price received. You don't have to do it by hand. Crypto tax software can automate this. Tools like Coinly, CoinTracker, ZenLedger, examples, connect to exchanges via API keys, pull in your history, sort and clean the data, and calculate gains and losses. They can even generate reports and export forms you need, like Form 8949 in the US or RF 1159 in Norway. In the USA, you list each sale on Form 8949, totals flow to Schedule D, and net gain or loss goes on Form 1040. The 1040 asks if you had digital asset transactions. Check yes if you did. In Norway, report crypto in your skattemeldingen, declare total holdings as of year-end and total gains or losses. Use RF 1159. Gevinst tap utbytte og formue på virtuelle eiendeler. Good documentation is key. Be ready to show how you calculated every gain or loss. Make it a routine. Start tracking from day one. Even a simple spreadsheet helps. Don't forget small trades or swaps between coins. Each one is a taxable event. Check estimated gains quarterly and don't wait until the deadline. Plan trades. Tax loss harvesting is a real strategy that can lower your bill. Paying taxes on crypto means you made a profit. That's a good thing, a sign of success. Keep good records, lean on technology, and take it one step at a time. Now go be a smart, informed investor.